Welcome to the Wall Street Geek, where geek rules the world, helping you to become better informed about important money matters. But first, I've got to thank you. Thank you to all of my subscribers. I really appreciate that you take the time to watch my videos, to read my blog, thewallstreetgeek.com, and to follow me on Twitter @WallStreetGeek. I started syndicating my videos on iTunes last week and became a top 10 business podcast, was listed new and notable, and was a top 10 hottest videos. As a thank you, I'm in the midst of a big overhaul of my blog to add more information from various sources. I'll release it any minute now, so goodbye to the simple one-column layout with a white background, and soon it's hello to a really informative newspaper-like site. So stay tuned, thewallstreetgeek.com, and thank you so much for watching. Now, on with the story. It's actually based on a question I recently was asked, and it was, I understand that the PE of a stock is the price to earnings ratio, and that a bargain stock is one with a low PE. But what's the best way to figure out the growth potential of a company, especially a penny stock? Now this reminds me of my first physics class in college, where I saw the results and I got a 45 out of 100. So once I came to, after passing out, thinking about what my parents would think, because I was on an academic scholarship and had to make good grades to keep it, after I came to, I found out that the lowest grade was a 19 and the highest grade was a 51. The professor graded on a curve, so the 45 ended up being an A. But until I saw the other people's grades, I didn't have perspective on how I did. And speaking of perspective and research, that leads us to today's topic. Today's topic is about finding penny stock opportunities. In a nutshell, looking at just the PE ratio or other fundamental or technical characteristics alone won't give you the whole picture of the strength or weakness of an investment. In particular with penny stocks, you've got to compare its characteristics with the characteristics of more established companies, since typically you don't have much historical or technical fundamental data for pennies. So while pennies are attractive because the price is low, they're also very risky because there's not much history. It's like dating a new guy versus dating someone that you've known for a long time. Now, dating a new guy is really nerve-wracking because you don't know what you'll eventually find out, whereas meeting someone that you can at least gather information about is definitely less stressful. I mean, you Google people before you meet them, and I do that too. So imagine how stressful it would be if you couldn't do that research beforehand. So let's look at the components. What is a penny stock? It's usually, but not always, a stock that's trading under $5. It's typically a company trading over the counter and not on a major exchange, and with low volume, which means that it doesn't trade often. And it's speculative, which means due to the lack of fundamental and often technical information, investors in pennies are taking a gamble. There's high risk in trading a penny stock in comparison to the return that you may or may not get. Since these trade OTC, over the counter, which isn't as heavily policed as major exchanges like the New York Stock Exchange or NASDAQ, there are lower regulatory standards when it comes to the quality and frequency of reporting their finances. But looking at the pros and cons, the pros are obvious. You can double or triple your money in one day because a penny stock can have high volatility. And you can buy a lot of shares of a penny stock with a little bit of money. That's leverage. But on the flip side, the price can decline rapidly, which is also known as taking a bath. And for many penny stocks, the financials aren't even public. So it's hard to do a fundamental analysis, which is a process by which you leverage financial statements to assess the strength of a company's earnings future. And when those stocks do make their financials public, they're not as heavily scrutinized by the SEC as investments on NASDAQ or the New York Stock Exchange or other major exchanges. Now, say despite this minefield of risks, you're still willing to take the risk and invest in penny stocks. Now, how do you choose a penny stock to trade? Well, I've got a two-step process which I'll share with you. It's a process that may help you get around the fact that there's not much information on penny stocks out there in terms of technicals and fundamentals, and the information that you have often can't really be depended on. I myself have chosen great penny stocks in the past, and I've invested in stocks that didn't go anywhere. Using the standard ways of evaluating a stock investment don't work here due to the fact that you don't have a lot of quality information. But you can take some of the unpredictability out of the equation by using common sense, familiarity with an industry, which is a tool that all investors use, including Warren Buffett, and technical analysis with the price history that you do have available on a penny stock. Now, I hope you come back because I'll discuss all of this next time. Because who really wants to download a 20-minute video, right? So I hope you'll come back for part 2. It'll be just as informative as I always try to be. So until then, this is the Wall Street Geek, hoping that you live long and profit. See you next time, and thanks for watching, thanks for coming back, thank you for subscribing, and thank you for telling your friends, okay? See you next time. Bye.